Frontline end is UltraTech under pressure post its decision to enter the wires and cables segment. Nigel, a couple of years ago, the announcement was on paints. Now it's cables and wires. Street is worried about, where it goes from here.
Well, that's right. The disruptors, right? That's the big fear. And UltraTech, late on Tuesday, they had announced that they're going to go ahead and they're looking at the cables and wires business. For this, they're going to be spending close to around 1,800 crores over the next 2 years. By December 2026, they expect the plant to be commissioned, and the plant's going to be located in Bharuch, which is in Gujarat. Now, why are they doing this? There's an industry tailwind because the industry is growing at around 13% approximately. It's an 80,000 crore industry that's expected to go to around 1 lakh. So that's the industry tailwind. Backward integration could help them because Hindalco is into aluminum as well as copper. So maybe some kind of support on raw material. Point number 3 is they're talking about UltraTech Building Solutions business, which has around 4,400 outlets. And they want to build on that. How do they fund this? Well, via a mix of debt as well as internal accruals. And remember, for UltraTech Cement, this will be hardly 10% of the total annual capex that they spend. So it'll be very, very small. They throw up cash flows of close to around 10,000 crores approximately. So it's very, very small in that scheme of things. What do the numbers suggest? They're putting 1,800 crores. Revenues at peak could be close to around 7 to around 8,000 crores. And margins that they'll generate will be in early teens. Now, if you're looking at the profitability at the margins as well as the ROC that comes up for you on the screen, in comparison to their core cement business, these margins will be relatively lower. But in terms of ROC, that's return on capital employed, it will be relatively better. The big question, why doesn't the street like it? The street wants them to focus on your core business. You're the master of cement. You stick to cement and keep it as clean as possible. They haven't done that. So capital allocation woes have returned. Point number 1. Second factor is, if you wanted to do this as a group, you should have done it under Grasim. Why are you putting it under UltraTech? So those are the two pain points. Jefferies, they had come out of the north. They're saying we're positive on the stock. If there's a knee-jerk reaction, they would consider it as a buying opportunity. So that's what they had to say. For the time being, the stock is down close to around 5% or thereabouts. And UltraTech basically has announced 1,800 crores of capex. They have lost market capitalization of around 12,000 crores. But the ones that are getting harder hit are the entire cables and wires businesses, because put it together, the total market capitalization that's eroded today is close to around 30,000 crores. So let's find out from Upasana more about that. Upasana, my big boy UltraTech making an entry into your space. Your space is very, very, nervous, and they're fearing that this is that big pains moment. Tell us more, Upasana.
Certainly, Nigel, my sector, that is cables and wire, is feeling the pain. The street fears the competitive pressure from the entry of UltraTech Cement into the cables and wires segment. Now, the company aims to meet the growing demand from cables and wires across various sectors, and the industry tailwind also remains positive, as cables and wires industry has witnessed a revenue CAGR of 13% in the past 5 years, that is from FY19 to 24. Now, let us look at the impact on cables and wires companies. Now, this may intensify the competition for existing large players. Now, we talk about FY24 market share. The top players such as Polycab, it stands at 26%. KI Industries stands around 12%, followed by Havells, which stands around 11%. Now, HSBC is of the view that this move is likely to have a material impact on revenue growth and margins of these players beyond FY27, that is after the commissioning of the plant. And it has lowered its target price between 7 to 23% for all the major players in the space. It has given a buy rating on Havells with a target price cut by 6.5% to 1,730 per share. Polycab, it has given a buy rating, target price cut as high as 20% to 6,250 per share. KEI, it has given a hold rating and target price cut by 23% to 3,450 per share, and RR Kabil, it is given a buy rating with a target price of 1,260 per share. Now, Jefferies believes that it foresees a lower competitive impact on Polycab as compared to other housing B2C players, that is Phenolics Cables and Havells, and it says that the Polycab continues to remain the preferred pick in this space. Morgan Stanley says that this move has surprised the street, but it does not see any concerns going forward. So all in all, these sector remained in focus. And now when we talk about the valuations of these companies, even after the steep correction, valuations are still above 5-year average is what we are seeing. So this space certainly remains the key focus and theme in today's trading session.
Thanks a lot, Upasana, for putting all those factors down very, very neatly. So for the time being, the street is very, very nervous on prospects of players from the cables and wires business. But we spoke to a couple of players, spoke to both KEI Industries as well as RR Kabil. Both of them, they believe that things are fine. The industry has enough of capacity to take in a new player as well, and they are confident about growth and profitability. Let's hear them out.
This and the market space is big enough to give space to another player. Number one. Number two, UltraTech will take minimum 3 years to start their production. Whatever somebody may say on paper, 2 years, but we have our long experience in developing the industries. Number three, it will take minimum another 3 to 4 years to or 5 years to develop the brand for wires. They may not be able to disrupt the market by just slashing the prices, because it is in this space it is very difficult to increase the prices once you slash them. There will be no problem in margin expansions because this comes by economies of scale. And I have said that we have no fear in our growth plan of 20% plus for next 5 years, doubling our turnover to 25,000 crore. And we are rapidly growing in the export markets. I see that in next 2 years, 20% of our sales will be coming from export markets. There is no question of any rethinking of capex. In this year, we are doing a capex of close to 800 crore, or next year the capex will be 1,000 crore, which is ongoing at our new plant coming up at Anand. And in the next financial year also, we will be doing a capex of close to 800 crore. We will not be reviewing or reducing our capex plan, and our growth trajectory will remain the same.
This is very big industry, and like almost 85-90,000 the industry size was last year, and it is further grown by almost 13 to 15%. And this is such a fragmented industry, and there are not many even unorganized player also. So if a big player comes like this is always a nice move where more strong player will be like get bigger margin of market share. And though it is very like quick reactions from market, and it is very like on negative side market is concerning. But what I see, this is like for players like us, it is good time that we can also have our growth plan intact, and we see good consolidation in market. But it is not that much like disruptive what market is reacting as per me.
All right, let's get an expert view. We have Manish Valecha, the research analyst at Anand Rathi Institutional Equities, who joins us on the show. Hi, Manish. Good afternoon. Good to see you in. Normally, we call you and we ask you, what about the cement industry? I know the last many years, we have had a lot of chats on that. But now let's talk about the space that's being challenged, because the big boy UltraTech is eyeing the cables and wires business. All the stocks are down. What is your recommendation? Do you believe that this is a good buying opportunity? Because a lot of investors are very, very nervous about this big conglomerate getting into their space. Your take.
Hi, Nigel. Thank you for having me on the show. A quick, working that we did on the announcements. So basically, if I work out on UltraTech's plans in terms of numbers, they are looking to commit 1,800 crores in capex, which on a 3.5-4 times asset turn gives them a 6,000 to 7,000 crore of revenue. Now, let's say 90% utilization with 8 to 9% PAT margin gives them about 600 to 650 crores of profits in the first year of full operation. Even if I give them a 30 to 40 times of multiple, that works out to be 22,000 crores of market cap. But the impact today in the top 5 players itself is about 31,000 crores, which has been wiped out. I think from the cables and wires business perspective, there is slightly an overreaction, and this could be an opportunity to buy into these names.
In that case, what would your pecking order be?
We like Polycab, followed by KEI, and then Finolex cables.
Just a left field thought. If UltraTech really wants to be very aggressive in this, they can totally erode the margins of all other players, right? Lead into a price war, because with the kind of cash that they generate, it won't make a very big dent to their EBITDA, but in return, they will get the entire market. And as a result of which, all the others will get disrupted. Is that a possibility? Do you fear that would happen?
Yes, that's very typical of both UltraTech as well as the group. I think we have seen it multiple times, both in cement as well as on the paint side. I do not deny that there could be an impact in the first or second year of operations, where there is a fight for market share. And maybe once they have reached a 3 to 5% market share, I think that is when the margin or the race for cutting on margins will end there. So we believe, yeah, maybe there will be 1 or 2 years of impact, that too in FY28 and 29. That could disrupt the market a bit. By the time the other players will also gear up in their defense. So I don't see a very big impact coming in.
You don't see a very big impact coming in, but there's a possibility that it could happen in FY28 or FY29. But you would remain a buyer on these stocks, right? Are we getting that correct?
Yes, I think the reaction to a large extent has already happened. So yes.
Okay, so you think almost all the bad news is in the price post today's damage, right?
Yes, more or less. Yes.
Okay. All right, Manish, just a question. Everyone's talking about, because of recency bias, everyone's talking about what happened in the paints division. But we need to keep in mind that those paint stocks were trading at multiples of 65, 70 times as well, which we did see a big derating out there. These companies are in the vicinity of 30 to 35 times odd. Do you think there's a valuation derating that will take place also? Or do you think, it's pretty much okay right now post this correction?
So I think there were two major differences. One, as you mentioned, they were at 60, 65 times. And second, that industry itself was not growing, right? Compared to these companies, in fact, the impact should have been much lesser, given the industry itself is growing at 11 to 12% CAGR for last 3-4 years, and in fact going forward also looking at 13% kind of CAGR to grow in the next 3-4 years, and they are trading at a much lower multiple with given their current return ratio profile. So I don't think a similar kind of an impact should be warranted for wires and cables. What happened in paints?
All right, Manish, thank you so much for joining in and giving us your view on the space. You remain a buyer. You believe that today's reaction has everything priced in. And, Polycab and KEI in particular are stocks you like from the pack that has seen the most amount of destruction in today's trading session. Let's move on then. Let's get in Deven Choksi of DR Choksi Finserv Private